Bring in a heavy hitter now who has deep personal knowledge of the Fed. Our next guest says this inflation battle was caused by the Fed's COVID response in the first place. The man who helped implement some of those policies says they were necessary at the time, but warns they also gave the Fed unprecedented power that could be dangerous. And he says the Fed should have pulled back sooner to prevent this inflation. Joining us now is former Federal Reserve Vice Chair Randal Quarles. It's great to have you here. Welcome.
Thanks. Good to be here.
Can I ask you to weigh in on the inflation debate right now? Should they stop, given what's happening with some of the forward data?
No, I think it would be premature to stop, but I think it's also, this is very positive news. The good news about the inflation being principally driven by overstimulated demand is that that's something that the Fed's tools can respond to. And they're beginning to have an effect. It's going to take a lag for monetary policy to have an effect. So the strong moves from the summer and the fall, you'd expect to begin seeing them working through the economy right now. And I think we're beginning to see them work through the economy.
Randy, nice fire out there. Is that Utah where you've had a ton of snow?
This is Utah. It's a great ski season.
How many inches? Like 30 inches in the last 3 hours, right? I mean, it's crazy.
Every day it's been
amazing.
Dumping.
Well, let me ask you about cold and hot here. How concerned do you think the Fed is by what's happening with financial conditions? We just had a chart up of the 2-year. It came down with the jobs report. It came down again today. The Fed keeps talking 5. The market keeps answering 4. Yeah. Is that a problem? And should the Fed do something about it? What could it do if it should?
So it makes the Fed's job harder because I think it's very clear, the news is positive, but we're absolutely not out of the woods. And I think that future rate increases are necessary, and they're going to be held for longer than the market expects. That's just necessary given the way the world works. The Fed is signaling strongly that that's going to be the case. And the more the markets don't listen to the Fed or don't believe the Fed, then the harder it is for the Fed's policy to have an effect, and it's going to have to possibly increase more than would otherwise be necessary.
Randy,
so it makes the job harder.
Let's put back up the chart of the 3-month 10-year here, which is now at a new, let's just call it record low, 115 basis points right now. Why does everybody say the markets need to listen to the Fed when it appears the Fed needs to take more seriously the message coming from markets, unless you think they need and want this deep of a looming downturn in order to cure the inflation problem? Do you think that's what's happening here?
No, I mean, I think that a recession is, extremely likely, almost inevitable. I think that recession is, given comparison to history, on the short and shallow side, given the fundamental strength of the economy. So all of that's going to be necessary. But again, to the extent that prices in the markets are reflecting a lack of confidence in the Fed's resolve, or a belief that the Fed is going to begin pulling back from the terminal interest rate relatively soon, those are mistakes and will in fact result in the Fed having to go higher than otherwise.
Here's my question, and maybe both of you can weigh in on this, but Randy, it would appear to me if we get negative job market prints, why shouldn't the Fed immediately respond to that with rate cuts? I mean, why would they keep rates where they are if by definition cutting the labor market means wage growth is going to slow? I don't understand why they'd say, no, we're just going to keep the rate at 5% and just ignore it.
Well, it's not ignoring it. It's recognizing that you've got a lot more progress to make. So there has been progress in wage pressures. Obviously, the jobs report from last week was positive on that front, but there's still a lot of upward wage pressure. And you have to see, you're particularly when you're dealing with expectations, you have to see sustained progress and sustained moves towards a level that's much closer to the Fed's targets in all of those areas, and particularly much closer to the 2% inflation target before you can begin to ease. Yeah. It's not a question of, the numbers are beginning to move in the right direction so we can begin to move our policy, because that causes people to say, they're easing and we're going to respond accordingly. You have to keep inflation at the terminal rate for a relatively lengthy period of time, certainly lengthy compared to what markets appear to be currently expecting.